Ladies and gentlemen, today I'm breaking down the secrets of the wealthy. But these aren't complex tax loopholes or hidden offshore accounts. They are simple, timeless rules for investing and for life, from the single greatest investor in modern history, Warren Buffett. For over 60 years, from a small office in Omaha, Nebraska, he has systematically outperformed the market, building a fortune of over $100 billion using a set of principles that are so simple, they are profound. Welcome back to Clever Money Hacks, the place where you learn the wisdom of the masters and apply it to your own life. We are about to decode the 5 core rules that govern the Oracle of Omaha. And we're starting with his most famous rule of all, the one that governs every single decision he makes. Rule number 1, never lose money. And rule number 2, never forget rule number 1. This isn't just a clever saying. It's a profound philosophy about prioritizing the defense of your capital above all else. It is the unshakable foundation upon which his entire empire was built. Now that you understand his foundational principle, let's break down the other 4 core rules that you can apply to your own investing and life to build sustainable, long-term wealth. But first, our crucial reminder. The information provided in this video is for educational and informational purposes only and should not be considered financial advice. Investing involves risk, including the potential loss of principal. Past performance is not an indicator of future results. Always conduct your own thorough research and consult with a qualified financial advisor. This video is not sponsored. Let's do a deep dive into that first, deceptively simple rule. Rule number 1, never lose money. At first glance, this seems impossible. Every investor knows that stocks go up and down. Even Buffett has had investments that have lost value temporarily. So what does he really mean? He is not talking about the temporary, paper losses that happen when the market fluctuates. He is talking about avoiding a permanent, catastrophic loss of capital. He is talking about playing a game that you are almost guaranteed to win over the long term by simply not getting knocked out of the game in the short term. Think of it like a ship captain. A captain's primary job is not to sail as fast as possible. It's to ensure the ship never sinks. Buffett views his capital, his money, as his ship. His first priority is to protect it from fatal blows. This philosophy forces a mindset of extreme discipline and risk aversion. While other investors are chasing high-flying, speculative stocks hoping for a quick 10x return, Buffett is looking for stable, predictable, and durable businesses that have a very low probability of going bankrupt. The core tactic he uses to achieve this is called the margin of safety, a concept he learned from his mentor, the father of value investing, Benjamin Graham. The margin of safety is simple. You calculate what you believe a business is truly worth, its intrinsic value, and then you refuse to buy it unless the market is offering it to you at a significant discount to that value. For example, if you calculate that a great company is worth $100 per share, you don't buy it at $100. You wait patiently, perhaps for months or even years, until a market downturn or a temporary problem causes the price to drop to $70 or $60. That gap between the real value and the price you pay is your margin of safety. It's your buffer against being wrong. It's your protection against unforeseen problems. It ensures that even if your calculations are a bit off, or if the company faces a minor setback, you are unlikely to suffer a permanent loss of capital. This defensive-first approach is the bedrock of his entire philosophy. Now for his second principle, which is the secret to how he avoids making big mistakes. Rule number 2, invest only in what you understand. Buffett calls this concept the circle of competence. He believes that every investor has a circle that contains all the businesses and industries they know and understand deeply. Inside that circle, you have an edge. Outside that circle, you are just gambling. The size of your circle is not important. What is critically important is knowing its boundaries and never, ever straying outside of them. This is the reason Warren Buffett famously avoided the dot-com bubble of the late 1990s. While other investors were getting rich, on paper, buying any company with a .com at the end of its name, Buffett sat on the sidelines. He was openly mocked by the media for being old-fashioned and out of touch. But his reasoning was simple. He publicly stated, "I don't know what these companies will look like in 10 years. I don't know how to value them. They are outside my circle of competence." When the bubble burst and those high-flying tech stocks crashed by 80 or 90%, Buffett's discipline was vindicated. He didn't lose money because he wasn't playing a game he didn't understand. How can you apply this? You must be brutally honest with yourself about what you know. If you are a doctor, you have a deep understanding of the healthcare industry. If you are a software engineer, you understand technology companies. If you are a lifelong video game player, you understand the gaming industry. Start there. Invest in the areas where you have a built-in advantage. It is not a sign of weakness to say, "I don't understand crypto well enough to invest in it," or "I don't know how to analyze a biotech company." It is a sign of immense discipline and wisdom. Your goal is not to have an opinion on every stock. It's to have a deep, well-researched opinion on a few great ones. We've just covered 2 foundational rules from the world's greatest investor. If you're starting to see that true wealth is built on discipline, not just daring, hit that like button right now. And comment below, what industry is inside your personal circle of competence? Now for the rule that explains how he built his fortune. Rule number 3, our favorite holding period is forever. This rule is Buffett's simple way of explaining the single most powerful force in finance: compound interest. Compounding is the process where your investment returns start earning their own returns. It's a snowball of wealth that starts small but grows to an enormous size over time. Buffett understands that the biggest variable in the compounding equation is time. The longer you let your investments grow, uninterrupted, the more powerful the effect becomes. This is why he doesn't try to time the market. He is not interested in buying a stock and selling it a year later for a 20% profit. He is interested in buying a piece of a wonderful business and holding it for 20, 30, or 40 years, allowing its value to compound on itself decade after decade. Consider his investment in Coca-Cola. He started buying the stock in the late 1980s. He invested just over $1 billion. He never sold. Today, that position is worth over $25 billion. But that's not all. Every year, Coca-Cola sends him a dividend check. This year, that check will be for over $700 million. That's a $700 million annual return on his original $1 billion investment. That is the power of buying a great business and holding it forever. This requires a mindset that is completely opposite to the one promoted by the modern financial world, which is obsessed with short-term performance and constant trading. Buffett's approach is to do a lot of research up front, make a wise decision, and then have the discipline to sit patiently for decades. He says that the stock market is a device for transferring money from the active to the patient. By adopting a forever holding period, you align yourself with the patient and you allow the magic of compounding to work for you. This leads directly to his 4th and perhaps most famous psychological principle. Rule number 4, be fearful when others are greedy and greedy when others are fearful. This is the ultimate rule of contrarian investing. It means you must train yourself to act in the exact opposite way to the emotional herd. The stock market is driven by 2 powerful emotions: fear and greed. When the market is soaring, when stories of people getting rich overnight are everywhere, when your taxi driver is giving you stock tips, that is the time of maximum greed. The contrarian investor knows this is also the time of maximum risk. They become fearful. They don't buy into the hype. They might even sell some of their holdings that have become overvalued. Conversely, when the market is crashing, when the news headlines are screaming about a recession, when everyone is panicking and selling, that is the time of maximum fear. The contrarian investor knows this is also the time of maximum opportunity. They become greedy. They take out their shopping list of wonderful businesses they've always wanted to own, and they start buying them at a significant discount. Buffett's entire career is a masterclass in this principle. During the financial crisis of 2008, when the global financial system was on the brink of collapse and fear was at its absolute peak, Buffett was investing billions of dollars into great American companies like Goldman Sachs and Bank of America. People thought he was crazy, but he was simply being greedy when others were fearful. Those investments earned him billions in profits. To apply this rule, you must cultivate emotional discipline. You must learn to separate the short-term noise of the market from the long-term value of the business. You must have the courage to buy when everyone else is selling and the discipline to resist buying when everyone else is euphoric. This mindset is the polar opposite of a short-term trader who tries to ride the waves of emotion. The investor seeks to profit from those emotions. We did a deep dive on the differences between these 2 mindsets in our last video, crypto investing versus trading, which is a perfect companion to this lesson. I'll link that for you. Finally, we come to the rule that underpins all the others. Rule number 5. The best investment you can make is in yourself. While Buffett is famous for investing in stocks, he has repeatedly said that the single best investment anyone can make has nothing to do with the stock market. It's investing in your own skills, your own knowledge, and your own well-being. Your earning power throughout your life is your single greatest financial asset. The more you learn, the more you can earn. Buffett himself is a voracious reader, spending 5 to 6 hours every single day reading books, reports, and newspapers. He is constantly learning. He also famously took a public speaking course when he was young because he was terrified of it, and he knew that improving his communication skills would make him more effective in business. This is a profound lesson. You can increase your value in the world by acquiring new skills. The capital you generate from those skills is the fuel for all of your financial investments. You are the engine of your own wealth. Therefore, you must invest in maintaining and upgrading that engine. This means dedicating time to reading and learning. It means acquiring new, high-value skills. It means taking care of your physical and mental health. An investment in yourself pays the best interest. It's the one asset that no one can ever take away from you, and it will continue to compound for your entire life. So there you have it, the 5 core rules from the master himself. 1. Never lose money. 2. Stay within your circle of competence. 3. Think with a forever time horizon. 4. Be a contrarian. And 5. Invest in yourself above all else. These are not complex formulas. They are simple, timeless principles. They are a blueprint for a life of discipline, patience, and rational thinking. If this breakdown of Warren Buffett's wisdom has given you a new, more powerful framework for your own financial journey, show your support by hitting that like button. If you are committed to building your wealth on a foundation of timeless principles, then make sure you subscribe and hit that notification bell. And finally, let's make it real. Comment below, which of these 5 rules resonates with you the most and why? Thanks so much for joining us today on Clever Money Hacks. Our mission is to provide you with high-quality and valuable information to help you take control of your financial future, one smart decision at a time. Make sure you're subscribed and have those notifications on, because we're always working on new content to bring you more clever money hacks and actionable financial tips and tricks right here on Clever Money Hacks. Until then, invest wisely and keep making those clever money moves. Bye for now.